Good afternoon or good morning, depending upon where you are catching us from. I'm Brian Windsor, certified financial planner here at Bogart Wealth. 12:30 here on the East Coast. I'm going to give it another minute or so as we have more individuals coming in. Just a couple quick householding items about the webinar today. We'll have the Q&A, the question and answer section opened. I'll try my best to get to them as they come in. If not, then we can certainly answer those questions at the end of the meeting today. We're looking for about 45 minutes to an hour, depending upon Q&A, as we talk about tax planning for 2024. But also now, as we're in November, looking ahead at tax planning for 2025. All right, so it looks like we've stabilized with attendees, so that is a good starting point for us to get started. So as I mentioned before, I'm Brian Windsor. I am a certified financial planner here with Bogart Wealth. I am one of our vice president financial advisors. Work with clients daily to help them meet their financial life goals. And in today's discussion, we're going to be focusing on taxes and tax planning. What are some of the things that we need to know about to do or have available to us as we get closer to the end of the year? Also looking forward to 2025. First, before we jump into any of the topics, if you're new to Bogart Wealth, it's your first time looking to see the value add that we bring to the table as subject matter experts. We'll talk a little bit about the firm first, and then we'll dive into the topics, right, of tax planning for the rest of this year and for next year. Here we go. So Bogart Wealth is a independent registered investment advisory firm. We're located where I am right now in McLean, Virginia. If you're familiar with the area, 495 is behind me. And amazingly enough, there's no traffic right now. So if you have any errands to run in McLean, now's the time to do it before traffic picks up. We're about $3 billion in assets. Over 1,300 households look to us as their primary financial advisor. What really makes Bogart Wealth unique is our integration of detailed financial planning, tax preparation, as well as investment management. We are completely independent. The only way that we generate revenue is directly from our clients asking us to manage some of their critical life assets. Fiduciary first. We put our clients' interests above of the firm's. And quite frankly, that's a business model that has been quite successful for the firm as we've been growing leaps and bounds over the last several years. We have offices both in McLean, Virginia, and a few in Houston, Texas, led by our advisory team. What I think sets us apart on the advisory front is the majority of Bogart Wealth lead advisors, certified financial planners, the gold standard in working with an advisory team. So our advisors lead with financial planning first, defining your life goals. What are some of the areas of success and opportunities that you have? And through detailed planning, come up with maybe more appropriate solutions, whether it's for your lifestyle or even your legacy. Bogart Wealth, everything we do is, for the most part, is internal. All of our corporate structure is internal. Our money management team, our operations team, and our financial planning team, all located here on the 9th floor in McLean. A little different than other advisory firms that may, partition financial planning out or investment management in different places. Alex Spencer is our Chief Investment Officer. He leads our investment team. Certainly, if you have any questions about our investment management, let me know. But we focus on more of a strategic, diversified investment strategy as well as individual stock strategies. Offices here in McLean, where I'm at, and then as we mentioned in the Houston area. This is the lifeblood. This is the heart here, what Bogart Wealth helps our clients with on a daily basis. We meet with our clients at least quarterly, and certainly as life events pop up, get back to the drawing boards at any time. But what you're looking at right here is, again, is the core of what we look to achieve with our clients. It's an ever-evolving vehicle, and certainly as market events and life events happen, getting back to the drawing board and seeing how all of these factors integrate within each other uh, is what we believe can allow our clients to define a different level of success. Again, whether it's for their personal lifestyle or those that they love, and also maybe even the organizations that they support. So working with detailed planning first, helping assess cash flow, looking at it from a tax perspective, where do some of the headlights that we need to be made aware of on any future tax snowballs that we may have, helping with the investments, and then making sure that as we pass on, that what we have on file and all of our estate documents are up to being current and actually active, right? You have a really expensive estate plan, but if you don't notify your record keeper and update those, then they don't do you a lot of good. All right, let's jump into it. First and foremost, compliance wants me to read this disclaimer. We are not tax advisors. So as certified financial planners, we're familiar with current tax law, but Bogart Wealth is not a law firm or an accounting firm. What we're going to present today, subject to regulatory changes. In fact, a lot of the information we have is based off 2024 figures. I'll provide some of the updates that we've seen with 2025. But again, if you have any specific questions, consult your tax advisor for any personalized advice. All right. That got condensed down to 1 page. I don't know if you guys have joined me on this before, but it used to be 3 pages of disclaimers. So good to see that that's being cut down. All right. So today we're going to focus on some of the highlights of the Secure Act and Secure 2.0. How is that impacting your taxes? Whether it's today or also in the future, things about how things, go through your estate. Phase out of the Tax Cuts and Jobs Act, otherwise known as the TCJA of 2017. Look, guys, I'm not going to sugarcoat it. If nothing happens, it's going to be phased out. But I certainly think, and talking to a lot of clients as well, is that based off of the recent elections, I think that it's a lot probable to see either an extension or even that made permanent. Certainly, we have to wait to see what Congress is going to do, but I think all signs point that that the new Congress is going to work on some sort of additional tax reform or just extending what we have here. And then what are some of the really fun, neat things that we need to be thinking about when it comes to tax planning strategies? Things like backdoor Roth contributions. There's the mega backdoor Roth. Looking at net unrealized appreciation. For those that have been were with me yesterday in the New Jersey area, we did a seminar on net unrealized appreciation, and we're also talking about capital gains and charitable giving via donor advised funds. So those are going to be the 3 main things that we talk about today: Secure Act, Tax Cuts and Jobs Act, but more importantly, the strategies to consider. What are some of the things that I can do personally as I'm watching you, Brian? What are some of the things that I might want to consider for my tax plan, whether it is because we're getting towards the end of the year or there's a new opening in 2025, and how do we want to look at, attacking next year from a tax perspective? Okay, so let's talk Secure 2.0, passed in later 2022. Really what this did for the majority of individuals, it set forth a new time period for required minimum distributions. So for a lot of you that are turning 72 this year, you entered, in a few years ago, you thought that 2024 was going to be the year that you were going to take required distributions. Now that's next year. So if you turned 72 this year and you feel like, okay, I didn't have to take it this year, let's be aware then, hey, 73, for those that are born before the age of 1960, they have to take required distributions at the age of 73. For those born after 1960, good for you. It's now delayed to 75. So you get a little bit more time before you have to take those required distributions. A couple other updates. If you do forget to take them, they're not going to penalize them as much. So it's down 25% penalty from where it was at 50%. Catch-up contributions are more indexed for inflation. That actually is not changing for next year. Catch-up contributions for 401ks next year. Big thing too is like, hey, you can roll over your 529, a certain amount of money to your Roth IRA, especially for kids if you're overfunding accounts. Um, all right. A lot of other things that we have here. We have a whole section, bogartwealth.com, along with a whole other learning series that we have. So this is your first time checking in. What are some of the things that we provide really just to the public as well as education? That's at the core of what the firm wants to do, is provide education, financial literacy to the public. So we have a lot of really great information on our website at bogartwealth.com regarding retirement readiness. A lot of different topics that are there. So feel free to check us out. Anything that you want to know more about that you're not seeing on our website, shoot us an email, let us know. We can try to put some good content available for you guys. All right, this is what I just mentioned, required distributions being pushed back. So again, if you just turned 72 in 2024, be on the lookout that you got to take this next year. What are some of the things that they didn't do with the Secure Act that, maybe there were laws for or against certain items? Did they change anything? Everything in the screen has not changed after the Secure Act 2.0. Still do the fun backdoor Roth conversions, mega backdoor. We'll talk about what that looks like in a little bit, but that's still available for us to look towards doing. Restrictions on qualified small business stock, that's staying the same. Interesting enough, that remember before the original Secure Act of in 2020, you required distributions were originally 70 and a half, and then they got changed to 72. And then what we're looking at here changed it to 73 and 75. But funny enough, if we look to do what's called qualified charitable distributions, meaning I'm going to withdraw funds from my IRA, and for my charitable contribution, I want that money to go directly to my preferred 501c3 of choice. That can be done. A lot of times clients do that at times. Hey, I got these required distributions, forced income towards me. You know what? I'd rather have my favorite charity have that. That's great. Won't be added to your income for the year. Well, as they pushed out required distributions to 72, 73, or 75, that's 70 and a half, the original required distribution, which again was a trigger for a lot of people doing QCDs. They still allow you to do these qualified charitables at 70 and a half. So it's not necessarily not well known, but just keep in mind that if you are getting to this age, you are charitably inclined, talk to your advisor about, what's the preferred way of gifting. A couple other things that hasn't changed, pesky 10-year rule for beneficiaries. So as you may know, Secure Act, if you got an IRA and you pass it to your kids, your non-spouse, if you will, then for most non-spouses that they have to withdraw those IRA assets over a 10-year period of time. So certainly, for a lot of individuals can provide some pretty hefty tax implications for the children. All right, there's that website there. All right, so this is the Tax Cuts and Jobs Act. So here's what we're looking at right now. What we're looking at is if nothing happens, this is what is expected to change. Well, where we are right now is current, your federal income tax brackets, depending on certain levels of income. So you see that they're right now on the right-hand side, 10, 12, 22, 24, 32, 37. If Congress doesn't act, 10, 15, 25, 28, 33, 39.6. Now, so those brackets are supposed to increase. By doing that, you'll see the standard deduction cut in half. The cap on state and local tax, the SALT will also disappear. So if they don't do anything, then, well, we're supposed to, income brackets are supposed to go up. But we just had an election, and there is, I think a high degree of probability that you'll see rates stay, as they are now. But that's why it's important as you're looking to make any financial decisions. What we know right now is tax rates are where they are today. And what we also know in 2025, where tax rates are going to be with the new, different levels of income that you can take to stay in these certain brackets. 2026 is still an unknown. However, what I would be looking to do is that if you've made long-term financial decisions from 2026 and beyond based off of this TCJA being expired, then I think it's an important conversation to have with your financial advisor, within the next, 6 months to a year from now, is how do we look at 2026 from a different lens? Is there anything that we need to do ahead of time now to start thinking about that? Again, nothing's happened yet, but I think it's important to be understanding that there's a good likelihood that we'll see we won't see this increase in 2026. Okay. Some things haven't changed. Correct. Yeah. Even next year, IRA contribution limits are not changing. NUA rules are still eligible. Cost basis rules, everything stays in effect as far as passing on to your heirs. Nothing's changing for, your FICA Medicare taxes as far as the amounts go. Just the brackets are changing a little bit. We'll discuss in the next few minutes. All right, so some taxes that you can do as far as a way to help, save a little bit more for retirement, and then depending upon your income, you might be able to get some tax deductions. Anyone can contribute to a traditional IRA. You just need earned income. And for 2024 and also 2025, individuals can contribute up to $7,000 to these accounts. If you're over the age of 50, congratulations. I'll let you throw another $1,000 in there, so $8,000 for the year. Just depends on your income. If you make a certain amount of money in 2024, if you look at the right-hand side, depending upon your income for the year, you may be able to deduct it from your taxes. But if you make over that amount, well, you can still put the money in there, and the assets and the investments grow tax deferred. It's just that, well, I can't write that off on my taxes. The Roth account, a little bit different. Typically with the traditional IRAs, you see I put the money in, I get a tax deduction, monies grow towards retirement. That's fantastic. And then when I withdraw it, because I got a tax break up front, then I got to pay the taxes on that tax deferred growth. Roth, a different story. Roth is I put the money in after taxes. There's no deductions for a Roth. Money still grow tax deferred. Nice thing is that when I decide that I withdraw it, whenever that is, it's tax-free. All that tax-deferred earnings comes back to you tax-free as long as you meet some certain qualifications. One of them being as far as getting money into the Roth IRA. As you can see here, there's some income limitations for 2024. They've gone up a little bit for 2025, but still sort of around this ballpark of depending what your income is. If you're less than this, single 143, joint 230, then yeah, you could do the 7K plus, 10%, plus $1,000 if you're over the age of 50. If you're sort of, stewing about the idea of, gosh, what makes more sense for me personally? What should I be thinking about when it comes time for my situation, what I already have, my life situation, family, kids, what am I trying to accomplish? Let us know. I mean, again, at the heart of financial planning is different ways of us, being able to assist. And detailed financial planning allows us to say, well, what if we do the traditionals, or what if we do the Roth? What provides you the best benefit long-term when we look at end-of-life assets, when we look at your tax diversification, and when we look at, how these monies are going to pass through to your estate. These are all certain things that we can look at to help you guys, make appropriate decisions on how to save. Okay. Backdoor Roth IRA contributions. Again, we mentioned Secure Act. This is still active. Like, you can still do this. So remember, we mentioned that you make a certain amount of money, you can't contribute to the Roth IRA, right? We just saw that in this previous chart. Brian, you said if I'm single filer, I make less than 146, I can't put the money into the IRA. Yeah, correct. I can't just move my post-tax money directly into a Roth IRA, but depending, but there's this backdoor where it allows you to put your post-tax money into just the IRA. And I remember I looked at this earlier that anyone can contribute to a non-deductible IRA, right? I put the money in, I'm not going to tell the IRS I need a deduction because I made too much money. So I'm putting my after-tax money into my traditional IRA for this year, $7,000. I can then move that right over to my Roth because I had $7,000 after-tax money going into my traditional IRA. So there's no pre-tax money yet embedded in that traditional IRA. And then I can just take that $7,000 and move it over to a Roth and say that's a conversion. And am I converting all tax-free assets or non-taxable assets? And so there's a way to get your post-tax money into the Roth with this sort of loophole backdoor Roth IRA contribution. One roadblock, keep in mind, is if you have other IRAs that are around, like from previous 401ks, and you have some rollover IRAs and some traditional IRAs, the way the IRS looks at it, they say, okay, how much you have total in IRAs? And okay, this $7,000 that you want to move, what's the percentage of pre-tax money versus after-tax money? And that's the amount that you're possibly paying taxes on. So quick disclaimer, if you have no other IRA assets, this strategy will typically work to get monies over to the Roth without any tax implications. But if you got other IRAs, not 401ks, 403bs, that's all good. That's fine to have that shielded because that's in a different bubble. But any other IRAs, it could trigger that $7,000 to have some taxes associated with it. So not penalties and such, but the idea behind this is that I'm not going to pay any taxes up front or at all, but there could be. So, check with your financial advisor, or chat with us, and we can kind of give you the understanding about that. All right. We're getting to the last few paychecks of the year, guys. Looking at where the max is for 2024, taking a look at your provider, getting a sense to see, do I have any more room left to save for my workplace plans? For 2023, normally 401ks, 403bs, $23,000 is what we can put in for the year. For over the age of 50, that catch up is $7,500. And then between that and between what you can put in personally and your employer, a normal individual is $69,000. But if you're over the age of 50, you can put that additional $7,500. Then between you, your employer, the total amount of money that can go into your workplace plans are $76,500. So any tweaks that you need to make, let's just say you're under that and you want to get to that towards the year, you want to max out by the end of the year, this is probably the week or two to be considering updating that, because a lot of times if you're going to be making updates with your record keeper that you want to change your deferral rate in your workplace plan, it usually takes 1, maybe 2 payroll cycles to go through. Check with your provider, ask, but just be on the know that that's something to be considerate of. For 2025, what you don't see on this screen is that we have seen a lift in the 401k, 403b individual contributions. That's increased another $500. So for 2025, individuals in their workplace plans can contribute $23,500. Catch-up's all still the same. That hasn't changed. The maximum amount of money that an individual can put in instead of $69,000 is $79,000. So that's also increased between you and your employer. A little bit more money can go into there next year. So from that, if you're just going to hit the $23,000 at the very end of the year, that last paycheck, and you don't get any additional salary raises going into next year, then you may want to consider tweaking that salary deferral come the new year to have that updated for that additional $500 that you can put away. All right, cool. So that's the workplace side. That's our normal paychecks. That's, one of the biggest ways that individuals can help lower their taxes on a year-by-year basis is lowering their income if they save money into the pre-tax side of the 401k. There's also the Roth side, which, you don't lower your taxes, but you could get some benefits in the long run. Chat with us if you have questions on which way is best. We're in a hot real estate market, right? I mean, it's amazing to see how the real estate market has still been holding up pretty strongly nationwide. I think there's pockets throughout the country that's maybe not doing so hot, but it's certainly been a favorable time to sell real estate. Prices have been good. A couple things to be keeping in mind if you're considering selling your home. If you lived in that house for 2 out of the last 5 years, so that's been your primary residence for the 2 out of the last 5 years, there is what's called the annual exclusion or lifetime exclusion. And you can use this multiple times throughout the year. Each time you can use this amount. So if you're an individual, you can exclude $250,000 of your home, your proceeds from your home, your capital gains from selling your home, not your proceeds, but your gains between what you paid for it, what you put into it versus what you sold. That gain, $250,000 is a single filer you can exclude. As a joint, you and your spouse, up to $500,000 that you can exclude. So, selling a home is certainly a big endeavor. But one of the nice things with that specific tax code is that it's not a huge tax burden for a lot of us that are selling our primary home. Cost basis rules, couple things to note if you are active or have ever traded in a non-retirement account. IRA accounts, cost basis rules typically don't matter, but in my non-retirement accounts, I have my basis. Let's just say I have one security and I've purchased it several different times. Well, that's my tax lot. each specific lot, if I have to sell something, I can decide that this is the lot I want to sell. So let's just say security is at, $100 a share, and I got some lots that I paid $80 a share, and I got some lots I paid $20 a share. The one that I paid $80 for only has, a $20 capital gain. So the smallest tax liability. I can say, well, I'd rather sell that one as opposed to selling the one that has the larger embedded capital gain. So I get the same trade done, but I'm not going to hurt myself in taxes by doing that. All right. Social Security taxes. Some of the things that we see or we don't see, on our, unless you're looking at your paycheck every time or whenever you look at your paycheck. In 2024, any income up to 168,000, 6.2% of that is going to Social Security taxes. That number is going up in 2025. That number is increasing to $176,100. So for those that are, making that anywhere around that slightly above that 168 number, a lot of time what we see later on in the year, a little bit of a boost to your net pay. That might not be the case as rapidly next year, as there's another, $9,000 or so of income that's going to be taxable for Social Security. Here is our Medicare surtaxes. So for any income that we make above 200,000, a single filer is 250 for joint. There's an additional 1.5% surtax. Income above 250 is going to get that level. And then you have your net investment income tax, sometimes referred to as the Obamacare tax. So it's your net investment income or the excess of your modified gross income. If you're over $200,000, it's a 3.8% tax. If you're joint, 250, 3.8% tax. So it's the it's whichever is less, the net investment income that you have, certain things from like dividends, interest, capital gains, or modified adjusted gross income over 250,000 or so. All right, so this is 2024's tax rates. I'm going to comment briefly on how these are changing for 2025. The marginal rates, which you see in the middle, they're not changing, but the levels on taxable income are slightly going up for inflation. So what we see right now is that we're in a progressive tax system. So any income, my first $11,600 as a single filer, that's only at a 10% tax rate. Then any income above that, so from 11,601 to 47,000, that's taxed at 12%. Then any income above that, 47,151 up to 100,000, that amount of income is taxable at 22%. Some people will say, well, if I'm getting $100,000 of income, that 22% of what I'm paying is to taxes. No, that's not true. You're in the 22% marginal rate. Your average rate, when we look at the total dollars that you're paying based off of being in these brackets, if you're at the top of this $100,000, it's actually 17%. So that's my average tax rate. Next year, single filers expect to see these numbers go up subtly. This 11.6 is becoming 11.9. This 47 is becoming 48.7. This 100 is becoming 103. So a little bit of a difference there as far as expecting to see maybe, anywhere from a few $100s to a few $1,000 increases on those taxable income brackets. For joint individuals, this is what we're looking at for 2024. 25, similarly, you're expecting to see some increases. 23.2 at the 10% is becoming 23.8. The 12%, 94.3 is becoming 96.9. This 22, which is 201, is becoming 206. This 383, which is the 24, is becoming 394. So the larger you go, the little bit more that you can have to stay within those tax brackets. So for those that are working with us, we're doing Roth conversion strategies, filling in certain brackets as to not spill over to go into the next one. just know there might be some more bandwidth next year. So what you're converting in 2024, if your income's staying the same, might be slightly elevated in 2025, just because these brackets have increased as well. Okay. All right. So that's for 24 and 25. Yeah, ordinary income. If we don't know about trusts and estate tax rates, let us know. But any income that's going to be remaining in a trust or that's taxable to the estate, it's pretty quick run up on the tax rate there. Any income above 15,000 is taxable at a 37% tax rate. So certainly not a kind tax rate system for any income that's taxed on an estate or through a trust. Kitty tax laws, that's still, I think, staying the same. The first 1,300 of not net income tax on income is tax-free. The next 1,300 of taxable income is at a child's tax rate, which is 10%. That's what's called the kitty tax. Anything above $2,600 of taxable income in a UTMA account, which stands for Uniform Transfer to Minor account. It's like an account you can have for your son, your grandson, niece, nephew, where you want to help them save for something. It doesn't necessarily have to be for education. Like for my kids, they're for house down payments, weddings. Who know the heck what those things are going to cost in like 20 years. It's amazing. So having some monies that you can put aside certainly can be helpful. But with these UTMA accounts, these kitty tax, generally it provides a little bit more of a tax break where you're not paying as much in taxes, right? So a little bit of a benefit there. Capital gains, long-term capital gains. So this is what we talked about. If you are selling any investments, oh, good question. I'll get to that in a second. When you are selling in a non-retirement account, what I paid for it is what I'm selling at. The difference is my capital gain. And that's the amount of money I got to pay taxes on. So if I hold my investment for more than 1 year, 365 days plus, it is now what's called a long-term capital gain and has a different tax system, which is more favorable for a lot of individuals. And so for 2024, if you're single, the first $47,000 up to $47,000 of total income, which includes wages, everything, plus capital gains, or $94,000 for joint, that's at a 0% tax rate. So, I don't sleep on this. For a lot of clients that are in, low tax years for whatever reason, if you have some positions in your non-retirement accounts that are running some gains, look to shave some off because there's maybe a chance that could be completely tax-free to you. So check with your tax advisor, check with Bogart Wealth. We can help with that. For 2025, this is going up slightly to 47 to 48,000, and then from the 94,000 for joint and the 0%, that's 96,700. And then again, so if your income is between 47,000 and 200 as a single filer, or 94 to 250 as a joint, that's the 15% cap gains bracket. So that's a 15% rate. Next year, we're seeing this 200 number go up to we're seeing this 47, then it goes to the Obama surtax, the 3.8. That's where we get the 200 to 518. Okay, yeah. So this 518, which is the total 15% tax bracket, is going up to 533. And for joint filers, $600,000 is in the 15% tax bracket. Anything above that is now taxable at 20%. So again, something to be thinking about if you have any large withdrawals that you need to take from your portfolios. Just assessing where you are in 2024 versus 2025 to say that, well, I'm getting close to this 583. Maybe I don't want to sell anymore because I don't want all of a sudden spend now 5% more in taxes just to get that same amount of money I could get for lesser amounts for next year. I got a question that came in about the difference between marginal and average tax rates. I'm just going to come back and hit that real quick here. So marginal rates, that's the actual bracket that you're in. Again, any income between 0 and 23,000 for joint filers in 2024, that's taxed at 20%. Sorry, 10%. 10% of that, any wages in that amount is taxed here. Then income above 23,000, but up through 94,000, that's at 12%. So on and so forth. Any income above 94 to 201, that's taxed at 22%. But again, not every dollar is taxed at 22%. So that's where you're going to see a difference between your marginal rate. This is the amount that I'm paying on this next dollar that's coming in versus the average rate, which is of all of the income that I had coming in. So again, let's just assume it's exactly 201. Oh man, 201. For all the dollars that I had to pay through the 10, through the 12, and through the 22%, I average all of that out at 17.1. So that's where you're going to see a difference between the marginal rate and average rate. If that didn't answer your question, then shoot me an email or shoot me you can comment with your email address and we can find some time to chat about it. Medicare premiums. Oh, my favorite for my retirees when they, have different levels of income for the year. So depending upon your income for 2022 affects your 2024 premiums. Get a sense of what your modified adjusted gross income then leads to what your Medicare premiums are. Anything less than 206 for joint filers in 2022, they're paying the basic 174. When you go above that, then you pay more. So keep in mind what you do right now in 2024 is going to impact what your Medicare premiums are in 2026. As we know right now, Medicare premiums are going, the income levels are going up. So for individuals, now it's 212 for married filing jointly for 2023's income, what your 2025 Medicare premiums are going to be. It's 212,000. And then this 258 is becoming 266. This 322 is becoming 334. So we're going to see some changes, some increases to what our 2023 income is to in fact impact our 2025 Medicare premiums. Certainly look back. You can look at your tax returns from 2023 to see what your modified adjusted gross income was to get a sense of what your expected Medicare premium payments are going to be. All right. So that's where we're covering all of the nuts and bolts on the numbers, right? This is the amount that you can put in. This is the amount that you can move around. Now we'll talk a little bit more about what are some of the things that we can consider now, as we have, a month and a half left in the year, or what are some of the things we can look forward to doing in 2025? Maxing out 401k accounts or your workplace plans. A lot of times you contribute that on a before tax basis. So, for a lot of us, that's one of the biggest ways that we help lower our taxable income for the year. It's one of the biggest part of our tax planning strategies. I pay no taxes as it's growing, stays in this big tax shielded bubble. Accessibility can be an issue though. So if you need that money in the near term, and it might not be the best depending on your age, especially if you're still working. It's pretty inaccessible if you're still working to take funds out. But if you're retired, if you're before 59 and a half, there might be a 10% penalty on pre-tax assets. And then, even if you save it, you don't need it. That's where we get into those required distributions that we just chatted about, whether, 73, ages 75, eventually you have to start taking it out. That's a big part of clients. When we talk about tax planning, we are privileged to work with a lot of clients that have saved extremely well in their 401k accounts. Maxing out every year. We're not talking about people that have been saving hundreds of $1,000s each year. We're talking about, the diligent savers over the last, 20, 30 years of their career that they've been putting it away and they've seen growth. And a lot of times what we find is that the amount of money that the IRS says, hey, at 73 or 75, that you're expected to take out is all of a sudden in greater excess than what their expected cash flow needs are at the time. So you get into this required distribution surplus and this excess taxes, if you will, because you're paying money on income you're not using. If you haven't checked into that yet, just to see that if maybe there's some tax issues in the future, this is where you call us. This is where you want to chat with us. We work with our clients and prospects complimentary to help them look at their situation and project what that looks like. Quick question came in. Required minimum distributions cannot be converted to a Roth, correct? Yeah, that's right. It can't. Man, that'd be great if it could. No, but the way that the IRS looks at it as is that, yeah, you got to pay taxes on it. So that's why the money has to leave. But they don't want that money to then be put right back into a tax deferred vehicle. So with RMDs either have to be paid to you directly. You can move it into a non-retirement investment account. That's what a lot of clients will do if they have excess, and they just reinvest it in a non-retirement account and have to deal with interest, dividends, and capital gains. Or they can, give it or donate it via qualified charitable distribution to their charities of choice. There's limitations on that. I think it's like 105,000 this year. That they can put away, and it's going to index for inflation next year, but that's the maximum that they can do for a qualified charitable. So we mentioned the pre-tax accounts, lowering your taxable income, but the other way of looking at it is I have a Roth option available to me. What should I be thinking about? Well, number one, if you're contributing to a Roth, you're not saving into this pre-tax source of money. So you're not lowering your taxable income. So it's more expensive for you each year to save towards a Roth, but it comes with some benefits. So I don't get the tax benefits up front, but I'm going to get the tax benefits on the back end of it, where I don't have required distributions. And any money I take out after 59 and a half, assuming that I've had the Roth open for 5 years, I can take it completely tax-free. Again, I hear a lot of clients, which way do I do? This is where we can help you with. But also one thing to mention is that, at the very bottom of this screen, beneficiaries inherit tax-free. So that's true. A big difference on the decisions you make today and how it impacts, your estate, your loved ones. The pre-tax monies that we just looked at here, when they inherit it, they have a 10-year period of having to withdraw it all. Same thing with Roths, 10-year period, got to withdraw it all, but guess what? It's all tax-free to your heirs as well. So determining, which account you save into can certainly be part of even your current estate plan. Figuring out, well, what we're saving right now, what are these assets really going to be earmarked for? And then also, how do we invest this money if we kind of know there's different time periods that they're going to come into play? That's, I think, one of the unique advantages of working with us is we have that type of insight and can provide you that type of advice. Roth conversions. So at any time, if you desire, and it's no income limitations, it used to be back in before 2010, there's had to be some sort of income limitations. But now it's to a point where any amount of money you have in your pre-tax vehicles, like your IRAs, pre-tax IRAs, like rollover IRAs, if I decide I want to take, X amount of dollars and I want to move that over to my Roth, I can do that. Even if I'm under the age of 59 and a half, I can do that without that 10% penalty because I'm not taking the payments myself. I'm just moving it to another retirement vehicle. So by doing that, I'm paying taxes today, locking in my taxes for that. And I'm moving it over to a vehicle, Roth IRA, that's going to grow tax-free. And if I ever need it in the future, tax-free withdrawals, or again, passing it on to my heirs. We talked about the backdoor Roth contributions a few minutes ago, where it's not just making a conversion from existing monies, but if I have new monies, I may be able to do a quick pit stop in the traditional IRA and get it over to a Roth IRA. We're in November. We're getting to a point where we're going to see a little bit of individuals look to do this type of strategy. And if you're not sure what this is, I'm going to briefly touch base on it, but we also have more information on our site about the Mega Backdoor Roth. Mega Backdoor Roth is where you can take an after-tax contribution. A lot of times it's you sending in a check to your 401k provider, and you're making an after-tax contribution to an excess, and this is an excess of your 23,000 or 23 or 30,000 that you're putting in yourself through payroll deductions, and you're using it to fill out that maximum amount of money, 69,000 this year or 70,000 next year. So I'm putting in a pot of after-tax money. Again, your 401k's got to let you do this. Talk to your providers, see if they allow you to do the make it backdoor. But I'm putting this after-tax contribution into my traditional 401k, just like I'm doing with that IRA, and I'm letting it sit there for a moment, and then I'm immediately moving that over to a Roth because the 401k provider allows me to specifically take this after-tax contribution and move it into my Roth 401k source. The reason why I say that most people are doing this now is because there's that maximum that you can put in there in a year, 69,000 this year, but sometimes your employer is going to have a formula of the amount that you can actually put in as an after-tax contribution. And so typically you'll have that amount of money that you can do mid-December after the last contributions have gone in, your last payroll deductions have gone in. So if you're interested in a strategy like this, first, look at Bogart Wealth. We have a seminar on the Mega Backdoor. Learn more about it, but then contact your record keeper. Maybe early December to figure out, can I do this, and then work on figuring out the amount and then executing on that. Quick question that came in for the 5-year tax-free withdrawal rule for a Roth. Is that per Roth account or per investment rate made into a Roth? It is per Roth account. And actually some tax preparers will say it's just the first time you've opened a Roth. It doesn't even have to be the same one. But it's just a 5-year marker of having a Roth open, but it's not per investment. So this is what it looks like if you're making an in-plan conversion. This is an example of a 401k statement where you'll see that you have some after-tax money in your 401k. Quick disclaimer, just because you have after-tax money doesn't mean that all of your after-tax monies are after-tax. Let me explain. As you look at this statement, you see 4 sources of money. Monies that this client put in before taxes, monies they put on after tax, their company, and then their stock match account, like different benefits they had. But this number over here, this 562, this after-tax account includes the contributions as well as the growth. Remember, the growth is before taxes. So if you're looking at, well, what can I do as far as if I'm going to do an in-plan Roth conversion so that future growth is not growing tax deferred. So right now, if you have after-tax money in your 401k and you haven't talked to your record keeper yet, maybe that's growing before taxes. Check to see, do they allow me to do an in-kind conversion or an in-plan conversion where this, in this case, this 270,000 that this client put in directly, can I move that over to a Roth source tax-free? Because if I can flip that over, now all the growth that's associated with that is tax-free. Definitely might be something to be thinking about. Every 401k is different. You got to talk to your plan provider or chat with us. We can see what we can come up with. Again, there's the webinars on this, Mega Backdoor Roth, after-tax rollovers, plethora of information for you. Or if you got friends that are, didn't have time to join us today, want to learn more about this, shoot them our information. We're going to talk more about Roth conversions. Powerful technique that individuals do to help pay money at current tax rates, not have to worry about taxes in the future. You look to consider to do Roth conversions as part of your financial plan if you believe your average income rate in the future will be higher than your marginal tax rate today. Let me explain. Remember we talked about earlier, we had the 10, the 12, the 22, 24% bracket. So any income that I make today, if I am putting those monies into a 401k, I am lowering my income by that top bracket. So let's just say, for argument's sake, next year, the 22% tax bracket is going to be 206. And me and my spouse, we make 206,000. If I don't save any money, I'm at the very, very top of the 24% tax bracket. But if I contribute to a 401k, now my income is lower. So that's going against my marginal rate. But in the future, if I think that my average rate, meaning I got to take distributions from my account to live off of, that's going to be blended as an average rate, meaning I'm taking some from the 12, the 22, and I'm living off of that. If I expect that to be higher than what it is today, well, might make more sense to me to maybe go up to the 24% tax bracket if all of a sudden, my average tax rate is going to be higher in the future. You also consider if you think taxes are going to go up in the future. Now, I know what we're talking about with reality, come mid 2024, but certainly we don't know. We don't know the answers as far as what tax rates are going to look in the future. If you know, please let me know. I'm curious to hear all thoughts and opinions on it. But if taxes do go up in the future, converting now will help you save on the amount of taxes you're paying on those monies in the future. You also think about it at the very bottom, if you anticipate leaving a large legacy to families. I can't tell you guys how many times I'm chatting with clients, and if you're worked with me, you know that a lot of this, we not only see an end of plan number, are you successful or not? How much, do we believe your estate's going to be worth? But we can go one step further. What's the sourcing of money that your heirs are going to receive? And let's have a conversation. Let's just say you expect your children to be in their highest income years around the time of your passing, which for a lot of us is if we're passing in our, early 80s, a lot of our children are hitting their peak career years as far as earnings go. So now all of a sudden, I'm going to leave my legacy to them through my pre-tax IRAs at that very moment. The difficult part with that is that now you may think about a lot of your legacies going and get eaten up by the IRS and taxes. That's not part of what your plan is. Check into Roth IRA, Roth conversions, and see, is there a tax benefit through my lifetime to do this? And what's the benefit to my kids? So it can be one or the other. It can be tax savings in the future for you to do, but also be for more of an estate perspective. There's no required distributions. We talked about this a few minutes ago, but with your pre-tax assets, you will have to take some monies out. When you're 73, think about 4% of your total pre-tax assets you have to take out. By the time you're 80, it's about 5%. By the time you're 85, it's 6.5%. So the amount of money you have to take out every single year goes up and up and up. And so that usually, if your investments do well, then we'll see not only your portfolio grow, but also your taxes grow. That's that tax snowball that we see a lot of clients have. Any monies that are in a Roth, though, you paid your entry, you got in the door tax-free. You got in the door with already paying your taxes, so you don't have to pay anything on the way out. Yeah, here's those amounts. Yeah, you got to take out every single year. So certainly you can see the percentages on the left-hand side. Close to 4%, 73, and then grows and grows and grows. And by the time you're 100, 15%, 115, 34. It doesn't pay to live that long, guys. It doesn't. Too much taxes. All right. Yeah, if you have surplus requirements, yeah, again, if all of a sudden what we see with a lot of clients is that, hey, your required distributions are expected to be X, your expenses are Y, there's a big difference. And if we can see that ahead of time and in the future, and that's why it's critical. If you haven't sat down with us before, sit down with us. Let's chat about it. Let's do these projections to see, is this something we need to be worried about or not? And if we do need to be worried about it, do we consider things like conversions as part of our overall financial plan? A lot of times we do have clients do more of their IRA conversions after retirement. Because right now with if you're still working, you're getting closer to retirement, you're probably in your higher income years. In retirement, depending upon what your cash flow strategy is, you may be in a low tax bracket. And if you're not sure, again, check us out. We'll talk. But if you're in a low tax bracket, like a lot of us are in our first few years of retirement, that's the time. That's the time because we can start pouring a lot more money in those lower 10, 12, 22% tax brackets and filling those up and getting more into the Roth at that time. When we're in our higher income years, we can do it. But remember, that progressive tax system, maybe we're at that 24% tax bracket. If we do any more than that, now all of a sudden, all that income's taxable at 32%. I don't know. It might not be the best idea. We have a whole tree for conversions. as far as where do you think your tax rates are going to be in the future? What's your expected required distribution? The easiest thing I can say is we have sophisticated financial planning tools here at the firm to help ascertain what is the impact to your overall financial plan if you don't do Roth conversions, and if you do. If you do Roth conversions, we'll be able to show you, does it benefit you and your family on total taxes paid? Do you save any money projected wise by doing this, by paying some of the taxes up front, and you don't have the taxes in the future? Do you get a net positive? How does it impact then the loved ones that you support? And having a conversation about, if you don't do any conversions, this is the amount of money that they're supposed to receive in pre-tax monies and Roth monies and non-retirement monies. You do conversions, let's assess what that then looks like. Let's have a conversation about where your children are and what you want these assets to do to make that determination of, do we convert now or not? And if you do it in 1 year, it doesn't mean you got to do it in the next year. I work with my clients on an annual basis to check in to make sure that it still makes sense. Especially after the growth we've seen over the last few years in the market. I mean, that's if you hadn't checked in on it in a while, you had some growth in the accounts, and all of a sudden your required distributions are projected to be a lot more than you thought, which could lead to some of those discussions. This is an example of a client's marginal tax rate. This is that actual tax bracket that we were talking about earlier. So again, this is what we see a lot of times with clients. Hey, they're retiring in 2024. Gosh, they're going to be in a lower tax rate. But then guess what happens in 2037? Let's just say that this is when they hit required distribution. All of a sudden, their taxes are going up. Not because they're, spending more money. It's because the IRS is telling them, they got to start taking more money out. So if you do these conversions, here's what the impact looks like. Again, here's one of those visuals I was just talking to you about. Real life scenario, one of my clients actually. These are all future value numbers, by the way, so they look very large, but they are inflated because this is a future value number. We could bring it back in today's dollars. It's still going to be a good number, but it's going to be a lot less. But as it stands right now, this individual, assuming that they live to the age of 90, are projected to leave $18 million. I mean, what a fantastic legacy to leave, assuming it's your child, these types of assets. But going a little bit further in depth, 7.7 million of this is tax deferred money, meaning 7.7 million of this money is going to be taxed at their ordinary income brackets over a 10-year period. So think about, let's just say you have one child, $770,000 a year they're taking out. Where are tax rates at that time? It's a big number. Here's some of the peek through what our technology looks like. What if we did things like conversions? Well, so now the number hasn't changed. We're converting over $1.6 million up through a certain tax bracket. I think in this case it was the 22. Now we have 6.5 million of that 18 that's completely tax-free, and now only 5.4 million is tax deferred assets. Again, it's not completely solving the problem, but it's helping to alleviate it in an appropriate way that is mindful of your own tax bill and your tax savings. Every situation is unique. This is where you need to talk to us about what's your situation look like and what are the benefits. In this situation, obviously, if we convert and pay taxes now, we're lowering those effective required distributions. And in this case, with this is a real example of the client. We see on the right-hand side, estimated taxes they're paying each and every year. If they don't do the conversion, that's the base. If they do the base with the conversion that you see, my screen might be there, the bump. Running mini 1040s on the background, it's estimated that if they don't take any action throughout their lifetime, they're going to pay 3.5 million in taxes. If they do the conversions over their lifetime and lower the required distributions, now they're projected to pay only 2.9 million. So it's over $600,000 in estimated tax savings that Roth conversions save this individual over their lifetime. Just an example. Again, this is just used to illustrate part of our financial planning process and some of the tax planning strategies that, quite frankly, can show some significant numbers for some of our clients. So this is something that everyone should look into as they're getting closer to retirement or in their first few years of retirement. And then obviously has to be a point where you break even. I'm going to pay money up front, and then in the long run, I'm going to make money. But how long not half joking, like, but realistically, how long do you think you're going to live as far as getting this as a tax savings? That your heirs are going to get the savings no matter what, because you're already prepaying those taxes. But how long do you have to live to see the tax savings? And this individual, it was the age of 78, I think was the example that we were looking at. So things to be mindful of. Things to be mindful of as far as, does it help you save money on taxes or not? I'm going to wrap up in the next few minutes. Tax loss harvesting, getting to the end of the year. 2024 has been a year where most equities have gone up. So I can't imagine many people have seen this, but check into your custodian, look at your tax lots. If you have any assets that are showing a loss, you could sell them and you can use that loss to offset other gains of your portfolio in the year 2024, especially if it's been a year of growth and your money managers move some things around. Assuming there's going to be some capital gains. So if you're self-directed, look at your gains, look at your tax lots, and are there any losses available to help offset gains? Keep in mind, though, if you sell something at a loss, you cannot buy it back within 30 days. That's the wash sale rule. Basically, the IRS doesn't allow you to dump a security, rebuy it, and just use the loss. They make you wait 30 days to buy it again. So I can use that loss to offset gains in that year. I can also carry that forward to future years as long as I have it. No one's telling me I got to use my losses. I can just use them for a different day. So I can use losses to offset gains. I can carry them forward. I can also use $3,000 a year against my ordinary income. So if you have a lot of losses, you can certainly take them. And if you use $3,000 a year, you can use that as a way to sort of chip away at your taxes over time. Lastly, charitable donations. These are the qualified charitables. Any individual over the age of 70.5 can transfer up to $105,000 in the year 2024 from their IRAs to the charity. I get this question a lot. Donor advised funds. You cannot move your qualified charitable distributions from your IRA to your donor advised fund. Not allowed. Your charitable contributions from your IRAs have to go from your IRA directly to the charity. And that'll help suffice for your required minimum distribution. You don't get the deduction, but you don't have to pay the ordinary income taxes on that money either. Donor advised funds come into play, though, for those that have, certainly maybe appreciated securities, maybe stock that mom or grandma gave you, and you don't know the basis for it, or a stock that you bought that really has done well, you just don't want to sell it and pay the capital gains. Well, you can actually take your appreciated securities or even cash if you have it, and you can park that in your donor advised fund, your own charitable organization. You can invest the money. That grows tax-free. When you donate the money directly to the charity, you get your tax deduction. As it goes into the donor advised fund, then you can invest it or you can grant it to your charities whenever you want. You can also set a legacy on your donor advised fund. So you can have the funds in your donor advised fund and then schedule a legacy plan that even after you've passed, your donor advised fund is still in existence and paying out your favorite charities, for a course of like a 10, 20-year period so that your name also lives on. A lot of times I see clients with their religious organizations, setting up, some sort of payment off of that so their name keeps going for many years. Talks a little bit about that. Yeah, so I think we get it to the end. If anything that I said is helpful to you, that's fantastic. Let us know what's worked well in this presentation, what hasn't worked well. Let us know how we can help your situation. So if you have questions on your specific plan, if you already work with us and you want to, check in with your advisor about what we talked about, please do. But if you're new to us, let us know, bogartwealth.com. Feel free to drop us your information and we'll be happy to contact you, schedule a complimentary financial session, discuss some of these options, these topics, and how it can relate to you. So that was my presentation for today. I see here one last question, David. Thank you. What is a donor advised fund? A donor advised fund is a charitable investment that you can open on yourself. So we custody our client's asset at Charles Schwab. Charles Schwab has their donor advised fund. So that's like an investment account that you open. When you move monies into this donor advised fund, just like a normal investment account, donor advised fund, DAF for short, then the monies that you put in there are eligible for the charitable deductions that you can get usually if you itemize, right? So for those making or have deductions more than $29,200 for most, that's the standard deduction for joint filers. If you are having the ability of itemizing above that, any monies that you put into your donor advised fund may be available for tax deductions, just like if you would write a check to a charity. But the difference is that your donor advised fund, you can either put monies into directly via cash, or let's just say you have some appreciated securities or some stocks, you can move the stocks in there directly. So I don't have to sell my security, maybe pay these ridiculous capital gains that I have embedded, but I just shift the stock, my investment account, my donor advised fund. When that happens, I'm not selling the security, but the minute that money goes into the donor advised fund, that's when it triggers what my charitable contribution was. Once the money's in my donor advised fund, I can either, the stock is then sold. The donor advised fund sells it immediately, which is no impact to you because now it's in your charitable account. It's no impact to you. It's off of your books. You can invest it in different sets of, mutual fund-based investments that Schwab has. Or you can grant it to your organization right then and there. And through Schwab's website, you go right online and type in Red Cross of USA, and that'll pop up, or your local charitable church. As long as they're 501c3, they're going to show up in their search filter, and then you can just grant the money right from your computer right there. So it's a very unique way to help still give to the organizations that you support, but also maybe do it in a more tax mindful way, so that you don't have to write the check out of pocket, but maybe you can just move some securities that you don't want to sell, so you don't have to realize those gains, and you can just move it right in there. After a in-person presentation yesterday, and this, wow, hour long, my voice is pretty shot. Any more questions here? Q&A looks good. Still have a couple people hanging on. Cool. Well, guys, if there's no more questions, thanks for taking the time and joining me this afternoon or this morning, wherever you are. Appreciate you guys hanging out. BogartWealth.com if there's anything else that we can do to help. Cheers, guys. Enjoy the rest of your day.